Who's gonna do the intro?
Are we live? Are we live? Let's go.
Let's
Bring
go.
it live, man.
All right,
Huh?
Tom, let's go, man. You do the intro
All right,
today.
guys. Hey, good evening,
We
everybody.
got
Hey,
another
so
minute. We got another minute, man. Let's
oh,
get another
really?
minute. Let's
All
let some
right.
people filter in here.
Yeah,
Who's
let's
who's
make
in
sure
the house,
everybody
man?
joins.
Whoever is visiting, whoever is on a live right now, please let us know where you're from. Have you
Let us know.
Yeah.
invested in real estate before?
Do you like real
It's gonna be a
estate?
good one today, guys.
And if you have any
I
questions,
love real estate, man.
if you have any questions, feel free to start thinking about those questions and just start commenting when we are having the live.
All right, I think we're ready, man. Let's go. Let's take it. Let's take it to
All
the
right,
top, man.
guys.
Let's fucking go.
Another Tuesday. Another Tuesday. What? We're all
Yeah.
waiting on Tuesday for this Facebook Live. So excited to be here live with two of my great friends and partners. One is Dr. Jonny Walker, the other one is Dr. Noel Liu. My name is Tom Bibi Varghese. I am an entrepreneur, and I am the only one who's not a dentist among these three. But I'm so excited to be with you guys to do this Facebook Live. So today we are going to talk about some amazing things. Guess what, guys? Johnny just returned from a conference, so we all attend these
Mhm.
conferences, masterminds, and what? Guess what? It keeps our mind like fresh. Information is flowing, right? You meet a lot of people, so we're going to talk about that a little bit. We are going to do take some questions of a lot of these group. In our group, we have had several conversations. Noel, myself, Johnny, and the same questions keep coming up. So we want to talk about those questions and the answers, and so that again,
Mhm.
when you keep hearing that, it just gets confirmed in your mind. Some of the questions, it's the same things that keep coming up, so we're going to talk about that questions. We're going to talk about why passive investing, why you need to have different streams of income, why real estate, why multifamily, all those kind of stuff. Today is going to be a great show today. So if you're watching, you're in it for a treat. So take it away, guys. Noel, come on, go ahead and introduce
All
yourself.
right, guys. I'm here. I'm blessed with these guys here. Dr. Noel Liu with Secure, and basically, I'm excited. I got my other partner, Johnny and Tom, here with us, and all we do is just talk real estate here. So, what we are going to be talking about, like Tom just said, I'm definitely going to be picking some brains, sales from Johnny, like who just came back from this great event he went to. And yeah, so today, all about questions, all about pain points. What are you guys looking for? Some terminologies, basically just covering like a whole gamut of, real estate. I love real estate. Johnny loves real estate, and Tom loves real estate. So, Johnny, let's go, man. The floor is yours. The show is yours. Let's
How you
go.
doing, everybody? Thanks for joining us again today. I'm excited to be back. I'm invigorated from being at this conference. It was more than what you learn. I mean, it's the networking. You see old friends, and I was there to. One of the things that I wanted, the takeaways from this conference. It was a real estate investment conference, industry conference, including where my mastermind is part of. And we saw a guy named Jesse Itzler, which is a billionaire,
Oh
and
yeah,
he
he's
gave us
great.
an absolutely amazing speech. And he talked about the spiritual side. On top of making money and all of that is important, and we should get as much of it as we feel that we need to, but without sacrificing on the spiritual side, where we neglect our family or ourselves or our bodies or whatever it is, and we go through life without any of this. Because he said, if you can have $1 billion, and if your spirit is zero, then 1 billion times a zero is still zero,
Right,
right?
I
So
heard that, and that struck a
yeah,
chord with me when he
it
said,
was a
yeah.
profound speech. I mean, even we all do it sometimes as dentists. Sometimes we work hard, right? So we work hard and we try to produce and provide for our families, but sometimes we do it so much that we neglect life. We don't do.
Yeah.
Are we living a life worth living? Did we take adventures with our children? Did we go to romantic places? Did we do the things that we like to do? Did we sleep under the stars? Did I run the New York Marathon? Did I, whatever it is that may drive you, did you do those things? And that's what that's what life really is about. And so that's why this whole real estate investing, it just increased my resolve of why I should invest in real estate. It's building passive income so I can live a life worth living, right? So I can do adventures with my children, so I can take my wife to nice places on vacation for our anniversary, so I can do nice things for my friends in need, my extended family, poor people in Sri Lanka. I can help them get ahead. There's charity work. There's all kinds of things that I would love to do. Having the time and having the money and resources to do it. And that's what the investing in real estate is, what we're trying to achieve by that, right? So we can get this income. We've earned this income now, right? We've learned a way that we can get great income, but now a lot of us have learned that this isn't the right way. This ain't the best way to make a living, though, right? The realist, the dentistry gives us a huge leg up that we can now invest in things that can build income if we do the right thing. The thing is, majority of us don't do the right thing. We get our money in the wrong things. We don't save our money the right way. We spend our hard-earned money to buy the luxuries instead of tax, the heavily taxed dollars to buy all the luxuries. And we're essentially shooting ourselves in the foot. So, one of the other takeaways that I got from the conference was that I really got to meet with a lot of principals of a lot of private equity firms in all different types of real estate, from multifamily. I met with guys that were doing development, guys doing short-term rentals, storage, self-storage. I met other guys that were doing RV parks. And there's just a whole, spectrum of real estate investments. And I had a chance to pick everyone's brain and talk about to them, what do you think about inflation in this uncertain environment and rising interest rates and potentially continuing on, as inflation remains sticky, and how all of us are going to pivot. What's our strategies? How are we approaching debt? How are we approaching cap rates? How are we approaching negotiations? And, the best way to move forward. And those type of conversations is what pushes the needle in your investment, in your investment returns. Everybody, we were all talking about it. Everybody's been making money these last 10 years in multifamily, but now things are changing. This landscape is changing, so how do we navigate these waters? Before, it's like anybody can get in. It's just all the rising tide raises all ships. You just buy something and it's going up. Now it's going to become much more dependent on execution. There's a lot more execution risk. So who's going to be the driver of that property? Who is the sponsor? That becomes paramount now. Like, how many exits have this guy had? How many deals has they've taken full circle? Have they gone through adversity before? Because adversity is coming now. Right.
So that's a great point that you brought up, which is actually a lot of the questions that come up in my conversations and Noel's conversations is when they are looking at deals, right? One of the things is this a trustworthy group? Can I invest in this? Is this a legit group? And we even got questions saying, how do I trust? I mean, is this a scam? So that's
How do you know
absolutely
if it's a scam
important.
or not?
Right, exactly.
Right? I mean, and that's a legitimate question, because think about the scams. I mean, I'm watching Bernie Madoff documentary on Netflix, and I can't.
I got to
It's
watch
blowing
that
my
too.
mind.
Somebody told me it's great, right? Somebody said,
Unbelievable. Billions of dollars under the SEC's law. Sam Bankman-Fried, right? FTX. Elizabeth Holmes, Theranos, Enron scandal. These were all publicly traded companies where you have the documents. Everybody has free access to look at and do due diligence on these people, and they still missed it. SEC regulators went into Bernie Madoff's offices, raided the offices, and they still missed massive frauds, a massive Ponzi scheme, the largest Ponzi scheme ever. Tens and hundreds of billions of dollars. So what makes you think that in real estate that it's not possible? That's a very valid question, right? There aren't the regulatory peering eyes of the SEC regulating what we do in real estate as much. There's no oversight relative to being a publicly traded company, right? So the exemptions in the 2012 Jobs Act under the Obama administration, which defined accredited investors and gave exemptions for raising capital for real estate in this syndication model. And now this opens the door for potential massive amounts of fraud, right? So how do we
How do we
mitigate that
trust the
risk?
sponsor? I mean, how do we? Those are some of the valid questions that have come up, and that is great that we are talking about that, and it is absolutely critical that the history of the sponsors. Have they done other deals? Do we know them? So this is another reason why Johnny, like Johnny said, we go to these events. We are not picking somebody who sends us an email and says, "Hey, man, there's a deal out there. It's giving us 30x returns." Blah blah blah. We don't go after those kind of. We are not investing in anything like that. We meet these guys, have a
Yeah.
relationship, and
Let me add something. Let
yeah,
me
go
add
ahead.
something real quick here. Guys, believe it or not, Johnny, myself, and Tom, right now we have like multiple deals on our desk right now. We are going through them. And we are analyzing these deals. We're analyzing the numbers. We know the sponsors really good. Johnny has like a whole bunch of them. He knows those guys inside out. He trusts them, right? Me and Tom, we trust all our guys. However, we still run the math. So it's all about the track record, the relationships. And that's why it's very, very ultra important.
And trust is, no, just jump in real quick. Trust is one thing, right? But trust, but verify.
Yeah.
Trust, but verify. Always. Right. So go ahead. I'm sorry. So the trust level has to be there. Number one, that has to be there. But you can't just go by trust alone.
Exactly.
Right. So yeah.
And you know what, Johnny? You and I, we are both dentists. We both have our professional license on the line, right? And a lot of times when we do these kind of stuff, there we have to see like who we're dealing with. Tom, for example, he throws in like $100 grand on every single deal he goes into. So he cannot just keep his money and just kind of like go in and just put it with sponsors, which he does not trust. You guys get an email. Hey, check this out, like 3x return or 2.5x return, just on an email. Never met that person. How do you trust these guys? Now, that is something where I would have a little bit hesitancy to go and trust. Now, some of those deals that we do, I mean, these are all guys that we hang around with. So, valid question, and you should be concerned. Absolutely, 1,000%. Go for it, Johnny.
I'm sorry, say that again.
Yeah,
no,
keep going.
We need to verify. We need to trust. We need to verify. Yeah.
Right. So that's one thing, right? So now what else holds people back from investing? Now, if we're dentists, we learn all these terms about I ask any dentist what an MOD is. They're going to know what that is, right? That's dental jargon, right? What's RCT, working length, acute apical periodontitis. All these are jargon, dental jargon. The same thing with real estate. There's real estate specific jargon. Now, learning the basic terms of investing is wise to take upon yourself to do and learn, right? Like, because learning what a cap rate is, learning what net operating income is, these are not, if you can understand the Krebs cycle, if you can understand the setting properties of amalgam and all of these very difficult to understand medical topics, believe me that you can understand the simple math of division and multiplication of multifamily real estate investing, of investing, period. And that'll make you a wiser investor in no matter what you're investing in, right? These terms, I actually have a list of terms, essential terms. I made a YouTube video on all of them. I mean, it's still a work in progress. I'm going to post that in the link now so that you can check it out.
Check it out, guys.
And I realized that this is what people need to know. So that's why I created a list of essential terms. We're going to be putting that out on the website as well soon. All those terms. Then next, once you so say we know the sponsor, we have the jargon, we have the cash income. Now the next thing is, where do we get access to deals, right? access to real estate opportunities. And if we do have access to these opportunities, how do we know which is the best one? Do we just look at the rate of return? Well, this one has a rate of return of 18%, and this one's 16%. So this is a better rate. This is a better investment. I'm going to go for this one. Or the guys look better, or they put a better presentation material together. So this is the better one. How do you know? Right? So those are important. Going through these offerings, I mean, that's going through the offerings. That's well beyond the breadth of what we can cover, obviously, in a 30-minute live. But these are the type of things that we need to start to ask ourselves, right? So what we need to learn about in order to become a wise and prudent investor that can invest in a repeatable, predictable manner, not make money on a few deals, and then because you don't have the good principles in place, and now that the economy turns and you have to pay attention to details more, now you can potentially lose capital, which is unlikely to happen, with these type of deals, but you definitely may not get the returns that you're looking for. So understanding that is what next thing, right? So ability to analyze and assess the risk involved with deals. Nowadays, we have to be more wise and weary of the risk. Jamie Dimon of Jamie Dimon, CEO,
JP Morgan.
He said this time, most of the time people are worried about making money. How much money am I going to make? And for since 2012 till 2022, that was investor mindset. Because guess what? Everything's going up. And everybody got drunk on success and drunk on money, and they never thought the party would come to an end. So stock market kept going up. Real estate kept going up. Single family houses kept going up. Multifamily real estate kept going up. Cryptocurrency kept going up, right? So then when the dance ends, now all of a sudden, it's not about, hey, how much money can I make anymore? Stock market's down. Cryptocurrency's half of what it was, the valuation. Single family houses are starting to crack. Cap rates are starting to expand. So now how do we approach the waters? Now is when we separate the men from the boys, right? This is where great transfers of wealth happen. People that made money, that are artificially high on success, that happen as a result of the market, not because of their wise investment principles, right? This is where you see transfers from the bank accounts of people that understand and invest wisely from the ones that don't understand the game into the bank accounts of the ones that do understand the game. That happens every recession, right? So we need to position ourselves to make sure that we get it, right? So and the only way to do that is to have wise, prudent investment principles, so you can invest in a low risk manner. And then the final thing, say you have all of those things in hand, and this is probably another big thing for a lot of investors, is I have the money, I think this deal looks good, I trust this sponsor, everything is in place, but somehow I still can't go ahead and wire the money, right? And that comes to the mindset. You can't teach mindset. Mindset can only be kind of learned, and you got to figure it out. I mean, so mindset is about personal development. I mean, in my opinion,
and
there's a lot of people
that's 100% like wiring that money. Like you are ready to. I mean,
a lot of people get stuck.
I still, even today, I've done so many of those wires, but still, when I get to that,
you get a little nervous. I get it, to press that, send that wire.
So I remember the first time I had to send that wire. Man, I thought about it.
It's nerve-wracking. It's a lot of money.
That's a bridge you got to cross. That's, if you want to grow in wealth, I realize that you gotta cross that bridge. Once you do that, then once you do the 50,000, I mean, that's a mental block you overcame. Then 100K, I mean, then it keeps on rolling, and I'm telling you, you are already gone to the next level. Okay.
You know what the problem with a lot of people, including myself, it's like you feel that is going to be the last time you're going to see that money in your bank account. And I think with this statement, I think I'm touching a lot of people with this statement, because that is exactly what I felt.
It's true. But how do you listen? How You should change the mindset too, the mind frame, because once you know it's a
Uh-huh.
solid deal, and you go, I'm excited too when I put that money out there, And
Yeah.
I tell
Yeah.
you what,
In
I'm
terms,
even more excited when I get passive checks coming in.
right.
And then I'm like, oh shit, here they I didn't work for this check. And that just the psychology of that is a lot better for me. It works a lot better
And
for
it's
me. Like,
it's
oh, my
it's
money's
it's
out there working.
Right, right, and also, guys, there's, I mean, there's so much learning. I mean, you can learn a lot. You should, but at some point, you got to take action. You got to pull the trigger. I mean, I met a guy at one of these conferences that I went to. He's sunk about 150K into these courses, but never been part of any deal. He could have taken the 150 or 50 and put into some deal. I mean, you got to pull the trigger at some point. Okay. I mean, education without action or knowledge without taking action is really not going to get you anywhere. So just wanted to point that out.
So guys, let me ask you this here. What I'm thinking is maybe a lot of times it's because people don't understand, right?
Yeah.
So I just want to kind of quickly get in your minds about what is it that they need to feel more comfortable in saying, like, you know what, I trust everything looks good, and I want to provide this money ASAP. There are a lot of investors like that, but what separates those guys from the guys who are not pulling the trigger yet? Is it lack of understanding? And I think it is, because if you don't understand, you feel uncomfortable. You feel like you're left out. So just kind of like really touch base on that real quick.
You mean like what is that? What is keeping them from pulling the trigger?
Yeah. So let's say if I get an OM and I'm looking at it, I'm a brand new investor. Now somebody just passes me that OM. So what is OM? OM is nothing more than just like, a deck of PDF slides, and you're just looking
Operating
at
memorandum, right?
exactly operating memorandum. You're just looking at all the pictures, you're looking at all the numbers, all the figures, all the projections. You're looking at, the city, the state, and all that good stuff there, the region. Like, for example, if I pick a property in Houston, I'm looking at all about Houston, right? So what is it in that OM? Some of the key pointers like a beginner should look at. And I just wanted to kind of you guys to elaborate that a little bit for all our new investors. What are they
So
looking for, and what makes them think it's a good deal?
I mean, I would say the first thing they got to, I mean, OM is operating memorandum that just pretty much a deck. Anybody can do a deck. So that's another thing Noel was saying. If you're going by the design and the style of the deck, there's people who can put nice decks together, but they may not be the ones that you should be investing in. So here's what you got to look at. What I look at, the first thing I look at is where is the property? Where is it located? What market is in, right? So that's the first thing I want to know before I do anything. I just want to know it's in a good location.
Mhm.
So is there Starbucks close by? Is there a Whole Foods close by? That's the first thing I want to know. The second thing is who sent this deck to me? Is it is it legit guys? Is it somebody that I can trust? Those are the so then I look at the returns. Those two has to pass before I even go further and look at the returns. So then we can talk about some of the terms. I see some of you saying that you have no idea about some of the terms. Some of them we can talk. Some of the terms are IRR. What is the internal rate of return? Right. We'll talk about that in a minute. Then, well, what are the other ones? The cap rate. What is a cap rate? What is cash on cash? What is a minimum investment? That's pretty clear. Minimum investment is what you need to put in to get into the deal. So let's talk about IRR and cash on cash. Johnny, did you want to take that? Hey, by the way,
No, I mean,
Melvin is
I don't
saying,
know if should we go into the weeds on that. I mean,
No. So
uh,
here's what I want you guys to answer this way. Like how we look at lab results, we see like, this is the norm range. Like, this is the low end, there's a high end. So if you look at IRR, if you look at a number, how do we know that's a good range? Just to kind of like briefly, just to for new investors.
yeah, just quickly say what IRR is and, internal rate of return is and cash on cash, cap rate, those are some sims. We can just spend a couple minutes on that. By the
okay.
way, Melvin just said you have to have conviction. For me, it was the tax savings. I don't want to give Uncle Sam one red cent. I totally agree with you, Melvin. I don't want to give Uncle Sam any of my money. They take too much anyway. So you don't need to be one of those person who is obligated to contribute because we are already paying our fair share with property tax, employees tax, payroll tax, business taxes. Sales tax, you add that up, almost more than 50% of your money goes into Uncle Sam. Okay, so we are paying our fair share already. So anyway, let's come back to what
I
internal.
just let me just quickly say for me personally what I look at the sponsors, the deal number
Yeah.
one. I look at the sponsors. I look at how many units. I will also look at what is the equity multiple, and I will look at what is the time frame, what's the business plan. Most of them will be like 3 to 5 year old, and then I'll also look at what is the current rents, and what is the comparable rents, and where are we at in the next 3 to 5 years. So just on a very high level, looking at the OM, this is what I will look at. Johnny, you got anything to add?
I mean, for me, honestly, I take a pro forma, right? When they give me a pro forma, this is the point that I'm trying to get to now, right? So my team now, look, this is when I take a sponsor's pro forma and I throw it out. Because when I'm looking at deals now,
Yeah.
I'm the first thing I'm looking at is who that sponsor is. I don't care too much about what they're saying their internal rate of return is going to be, what that cash on cash is going to be, because those numbers are completely dependent on the inputs into a spreadsheet. Whatever those assumptions are, how much you assume that your expenses are going to be, are they going to be reduced? How fast do you think you're going to achieve rents? How fast are you going to turn over rent? Those are all assumptions. How much rent growth do you think you're going to do? How many units are you think you're going to renovate a year to achieve this? And does that team have the capacity to do those things is what I'm concerned about. First and foremost, number one. Otherwise, I don't care how good the deal is, because I've seen in this game, you can take a great deal and take a shitty sponsor and they'll mess up the whole deal. And then the vice versa can be said too. Say you get a marginal deal. There's unexpected things happen. But so it's not a great asset, but you have a great sponsor that knows how to navigate uncertain times, waters, uncharted, untested things. Those are the guys that are still going to come out on top, and they can make a bad deal still work. So that's why execution risk is going to be the most important thing moving forward in the next 10 years investing, at least in the next 5.
Basically, you're betting on the jockey.
Execution by the sponsor is going to be the most important thing over the next 5 years, for sure.
And how committed are they to this
how
deal?
to navigate these, even the debt service. I was on an asset management call today, right? The debt service requirements are changing. Now even if the sponsor is performing great, but now the banks are coming with, well, these cap rates are expiring, and now you need to escrow X amount of dollars every month to buy a new rate cap just in case. And it's eating into a lot of operators' cash flows. Now, how are you going to navigate those waters as a sponsor if you've never had that happen to you? Are you going to go to your investor? Is you going to be a position where you're going to go to your investors and have a cash call? Are you going to stop making cash flow distributions? Are you going to run out of cash? Do you have floating rate bridge debt that now matures at double of what you were locked in at the beginning? Did you underwrite for that? No, those type of risks, that you didn't have those risks just 2 years ago. And now it becomes much, much more important to know their track. So that's why whoever is going to be boots on the ground executing that deal, you need to know how much track record do they have? What's their track record in that local market with that particular asset class and type? That's what I'm looking at. So I wouldn't even get past anything else. And in terms of underwriting, so now our team is getting more robust now, right? So we don't just take a sponsor's word for it. Okay, so look, we are going to underwrite our own properties, right? We're going to take a T12 and we are going to do this stuff. We're going to do this for ourselves, so that way we know what the assumptions are. We can be conservative in our assumptions, and we can come to our own conclusions at the accuracy of this sponsor's offering. Now, if this sponsor is offering numbers are completely different from what we're getting, and they're potentially over exaggerating the numbers or overly optimistic, it might not be deceive at all. They may just be overly optimistic, or they just might not have the experience to understand that this isn't actually achievable. And now if there's a big gap in that, then we don't trust anything else that document says. Throw that out. But if they're comparable and we're like, hey, look, these are reasonable assumptions, this only adds a layer of credibility to the sponsor. So to me, that's everything. I'm keen on partnering with the best in class operators in the best markets, and best in class.
This is why.
One second, Tom, because even when shit hits the fan, right? If people start foreclosing, your sponsors start defaulting on properties, whatever, if something really crazy happens, the best in class operators, the ones that know the best how to are the ones that are most likely to survive. It's the guys that don't have the cash reserves. It's the guys that don't have the knowledge, the capacity, the wherewithal to withstand a bad or down market, that are going to be marginalized first. So even if shit is a fan, I still think as long as you are partnered alongside the best of the best, strong operators with years of experience, that's how you're going to be positioned to win. So I don't chase IRR. I don't chase returns on investment because I'm a conservative investor. I like the bread and butter stuff that I'm going to just keep knocking out wealth, and I'm just going to keep pumping into it. And with compounding, my cash flows are going to keep multiplying. Wealth continues to multiply, because if you continue to invest year after year after year after year with great rates of return in a very low risk manner, that is a winning formula for success, building cash flows and immeasurable wealth. So you don't need to as a dentist, we have tons of money, we have a lot of cash that we can invest. We don't need to chase the shiny things, right? All we need to do is be prudent. At least with 80% of our invested capital. If you want to take some hits, you have to build a base first. Your foundation shouldn't be fancy. It should be solid. It should be concrete. Once you start getting into the fixtures of this house, right? Once you've built a strong foundation of investment, that's when you can start looking for do some more speculative things also. I'm not saying I only do the risky, the non-sexy, unrisky stuff. I do some riskier investment also, but I'm building my base of investment with low risk cash flowing assets. 80-20 rule, Pareto's principle. It applies here as well for investing. So that's my 2 cents on that.
No, that's an excellent point, Jonny. You nailed it right in the head, because this is one of those things. If you can navigate through these times when the sun comes up after 3 or 4 years or 5 years, when this whole weather kind of subsides, everybody will be on the upside. Now, here's the thing. You should always be investing. Like Jonny just said, like every single year after year, just don't hold back. Do your due diligence, do your numbers, calculate them, make sure like those guys who you partner with. So like for myself, my real estate experience is only about 2 years, but who do I partner with? I partner with, one of the best in the industries. I partner with guys with great track record, because, this is something which if left it to me alone, I will not be able to navigate it. Right, Tom? I mean, Tom is with 10X. Jonny is with Raise Masters. I am with Samrock. So we all have mentors. We all have people that we have connections with, and we all have people that have great track records. So this is how we get all those deals. And when I'm looking at the OM, again, like Jonny said and Tom said, look at it with a grain of salt. Always do your own numbers. One of the questions a sponsor asked me the other day was, hey, how do I go about getting the rent? I was like, you know what, dude, just go to rent.com, call up the property, call up the neighboring property, do your due diligence yourself, just walk it in. I mean, if you're in the area, just call them up, just go in there, just say, hey, you know what, I'm looking for an apartment. Do you have any availability? And that will tell you a lot of story that, hey, is it a good place? Is it occupied or is it not occupied? Right, Tom? Like how did we do with Grand Summit when we were there? Like some of those deals that we just called them.
Just call them on the spot and then check the rent. And so the other thing also, just wanted to touch on that. Yeah, you always bet on the jockey, not the horse. I am only wanting to invest in deals where there is a sponsor who is a boots on the ground. If he's in Kentucky and trying to invest in California, I'm not interested in that.
I don't like those guys. Those guys that are invested all over the place.
Right.
They're I'm not a big fan of that. I personally, I mean, I know a lot of guys do, but I don't like to. I don't invest like that. You know, I'm when I build a relationship with the sponsor, it takes a year. You know, a minimum, and then on top, a minimum, and then on top of that, I'm investing my own money on as a limited partner first.
Yeah.
You know, before we bring it to our groups, like before I bring it to my investment firm as opportunity, like there's a high level of due diligence that goes on. I mean, so, and that's paramount to
Yep.
doing investment predictably. But here, look, let's give some shout outs here. We have some questions to get to. I mean, we have a lot, we had a big showing today. Dr. Ify, I want to definitely shout out her. She's our
She's
Nigerian.
awesome.
I think she's maybe from Lagos, or is she was from the Southwest, the Igbo. I'm not sure. Of course, Melvin was dropping some gems here.
Melvin,
Conviction and tax savings is his reasons for investing. My boy Sonny. We got Vincent's online. I see Paul MD, Vivek. So questions. We have a question here. Ideally, what minimum dollar amount would potentially be beneficial to invest? 20K, 50K, or 100K? Or is it dependent on the group of folks you're investing with? Tom, you want to take that? Or?
Yeah, it's a great question, actually. Usually it's in the 50K to 100K range. So that's what all these real estate deals are. It is usually 50K. I mean, now a lot of them are 100K, but sometimes there's an option for 50K. So 50K is what I would say is a minimum. Right? What do you guys think?
I just want to add something real quick here. The lower the amount, the more work it is. And then eventually what happens is all the legal, the CPA, the financial, all that cost adds up, right? So if you're going to do like a 5,000 or 10,000, there's a lot of work, there's a lot of cost, and everything gets passed on to the equity. So for us to get the best bang for the buck and for the investors to get the best bang for the buck, 100K. I mean, that is my take on it.
Yeah.
I mean, yeah, there are, I know some sponsors that do like 35K minimum. Some people do, they do even small investments, 15, 20K. And then some crowdfunding, they even do like 5,000, you know, but
Yeah.
typically the deals that we do, I mean, we personally, like we do larger apartment building deals because there's lower risk in very large apartment building deals. Which is counterintuitive to a lot of people, but the larger the property, the more economies of scale in every aspect of it actually makes it it's a much more efficient process for management when you have a higher density of units. So with large apartment units, when we're doing 30, 40, 50, $100 million properties, you know, the capital raises are much larger. So as a result, our minimums are between 100K and 250K. You know, obviously the returns are great, you know, and very well risk mitigated with, you know, the best of the best type of operators with $1 billion under management. I mean, these are the type of people that you feel very comfortable to invest with because they've just been doing it for 30 years or whatever the case may be with that in that particular case. So we do, you know, we do have a larger, and, you know, our investor base are larger, you know, big specialists, big business owners that own, you know, large multi-million dollar practices. You know, a lot of our investors are like that. And it's not to dissuade anybody that's not there, because you will get there. You know, if you're already in this group and you're already trying to mindset investing 100,000%, you will get there. So, but I would say, yeah, to answer the question, is between 50K and 100K. But, you know, our investments
Ideally
are a little bit
100K.
bigger. Right. Minimum is 100,000. All right. So is there any other questions? Dr. Jazerli, my friend, he's an orthodontist here. And I think in Philly, right? I can't remember now. Yeah. So thanks for showing up. We have a remind guy here. This is Dr. Brian Craven from Springfield, Massachusetts. In your mastermind groups, is there any fear that inflation and increased interest rates will make some of the deals difficult to make the numbers work, especially when it comes to full cycle? Excellent question. One of the questions that we kicked around amongst our, amongst my private equity friends in the conference, it is this. You know, and underwriting properties gets challenging. I mean, you know, one of my guys, Jack Krupe, he's a principal at Apico Investments. Not Apico, that's Noel, but regardless, where he's from, Jack Krupe, we were talking about this. And we went into the due diligence phase, right? We had 60 days for due diligence. We get our initial interest rate quote at 3.5%. And then by the time the closing comes around, they jack it up to 5.25. We're up 200 basis points. And so now when you look at that, when you try to justify the deal, now all of a sudden the deal doesn't work anymore, right? So now this whole thing called retrading happens. So now we go back to the seller and be like, hey, look, we just can't make it work with these numbers. Sorry, we can't pay this. So now at that point, it's either the seller also understands that this is the times. They're not going to get what they were going to get 6 months ago. It's a logical part for sellers also. And if they're in a place where they have to sell, they're going to realize that nobody else is going to pay above what the interest rate is, So, I mean, unless there's a huge upside from value add, then, then somebody might take that on. But if not, it's, you got to buy the price. You got to buy it at the right price. In terms of increased interest rates are going to continue to go up. That's not going to stop. And if
that's
the Fed's
the other thing,
target is 2%.
Go ahead.
Yeah, sorry. Yeah, if the Fed's target is 2%, which is what they publicly stated, and we're at 7 or 8% right now, there's a long way to go. It'll take 10 years to get there. And this is a very mechanistic Federal Reserve in terms of the only knob they have to switch is the interest rates to control the whole economy, right? So it's a very delicate thing. And if you keep interest rates too high, country could go into a deepening recession, potentially topple into a depression, right? So where we get asset values get crushed and all of those things. So these are things to be very cognizant of when we're investing. And I put this to several people, and I didn't get an answer that gave me a lot of great comfort. But I do know if we get the debt right, we get the debt piece right.
That's the key,
we
right?
got the right guys executing, so we can lower the execution risk, right? Good track record sponsor where we can control the appreciation, force the appreciation by adding value to the properties, because we get properties that are producing less than what they could be potentially doing. And so we can drive the income and drive profits regardless of what's happening on the outside, right? So profits are built in as long as whoever is doing it can make it happen. So those things help reduce my fears. And I know that this is a better investment than anything else. Equities is a terrible. You think the stock market is going to go anywhere if interest rates are going to continue to go up and the economy continues to go decline as more jobs are continue to be lost and companies continue to downsize, especially in the tech industry? That's not going to slow down. That's going to speed up if interest rates go up. So now nothing, stocks aren't going to go anywhere. Crypto's not going anywhere. I heard somebody talking about in the group about investing in metaverse. I mean, to me, I wouldn't go there right now. That's just me though. But just me. But on the stock market, I don't see it to get to the 2020 level. It might take 10 more years from now just to get back to zero. So it's like, where is a better place to do it? Somewhere there's
so now the other thing also is right.
Like,
the other thing also is,
and just one last thing, just real quick, in terms of the refi, this is what at the end, right? Increased interest rates will make some deals difficult to make numbers work, especially when it comes full cycle. So when you're going full cycle, that's a very important point right there. Cap rates could slowly expand, right? So what does that do to terminal prices? So it really comes down to how well it's underwritten. How much upside is there? So is refinancing challenging in today's market environment? It was a lot harder 3 months ago. Banks weren't doing refis at all. They stopped doing refis because the bank wasn't even sure where things were going. So they don't want to get shot in the foot. Now but banks, the thing about banks is they're transactional. They need to be doing business in order to make money. So they can't sit on their hands forever. So now we're starting to see refinances happening again, right? So, there are ways to make it work, but it all comes down to how well underwriting for these type of circumstances. doing sensitivity analysis to what happens in an environment of high inflation and interest rates stay high. What happens if cap rates expand by 100 basis points or 150 basis points, which is unlikely to happen, by the way, but that's an argument for another day. But if that happens, what happens on the exit? How does that affect our returns? So all of those things that, the profits are built in the front end, as they say. So being with somebody that's analyzing and being cognizant of these type of headwinds is what will make the difference. So yeah, to answer your question, Brian, it's not going to be easy, but it's going to come down to just, again, wise and prudent investing.
Making the numbers work, basically. So if the numbers work, it's a great time to invest at any time. So it's not,
exactly.
right. If you
But
don't
two
have to
things
wait on the
too.
sidelines. What's that?
Just want to add two things. Number one is you got to buy it at a discount. I mean, that's the key.
Yeah.
If the interest is high, that principal's got to offset that interest. Number one. Number two is you got to be in a great location. Okay. I mean, you can't be like where I am in Illinois. You can't be investing here. Of course, then that number is not going to add up. Now, if you're going to be somewhere in Dallas, absolutely. So not all real estate are equal, but invest your money wisely and just make.
Yeah, and that's a great point for Brian's question. Look, Brian, that's the thing about real estate, right? There's still markets that are always growing. There's markets that are stagnant, where there's net migration is zero, people going in and out is zero, and jobs is zero. And then there's places that are declining, people are leaving, factories are shutting down, companies are downsizing, people are leaving markets. Those are declining markets. And then there's always increasing markets, because those people are going from a place where there's no jobs to a place where there is jobs. And even in a recession, even in a depression, there's still sectors of the economy that will still be profitable. Lockheed Martin is going to be profitable for next 50 years as the war machine continues to build tanks and bombs and things to send to Ukraine and ramp up production in case we go to war with China. Those type of companies are locked in Houston, right? Houston is a great energy producer. Houston is a great modifier of energy, refining. Like Houston is going to be probably the fastest growing metro over the next 50 years in the United States. So, paying attention to stuff like that. People are moving, lots of jobs, even in down markets. When you have lots of people moving to an area, competing for scarce affordable housing, that puts upward pressure on rents, even during a recession. 2008, we have historical precedent for that, but we're not going to go there. Okay, let's wrap it up, guys. This is the biggest showing ever. Shout out to everybody that came and joined our live today.
Yeah.
We love every one of you guys for being here. We love doing it. Right?
We just want to add, Dave, I don't think we were able to get to any of the all of the questions, but don't worry about it. You can private message or DM each of us, ask the questions. We'd be happy to get on a call or
we have more questions here too, but we couldn't even get to all of them. We'll get to them next time.
Right.
Let's put in the comments.
Next time. I have another call to jump on actually at 8:00, and another asset management call. But
comments, and we will answer it down there. No worries.
Yeah, absolutely, guys. Sorry if we couldn't get to your question. Yeah, definitely message us.
My guy Daquan Bivens too, Dr. Daquan Bivens, man. He gave a shout out to him too, please. All right, guys. Thank you, guys.
All right, thank you, guys.
Right, cool.
Next week, 7 p.m. live again. We'll see you guys.
All right, 7 p.m. Eastern, 6 p.m. Central.
7 p.m. Eastern, 6 p.m. Central. Be there, be